Welcome back to Asianomics. I'm your host, Alex. As we walk down West 43rd Street in New York City, a U.S. national debt clock displays a staggering $31.5 trillion, a mind-boggling 120% of the nation's GDP and nearly $200 billion above the legal limit. Despite efforts to curb its growth, the debt continues to mount at an alarming pace, leaving many to wonder if or when it will ever be brought under control. The mounting debt of the United States serves as a constant reminder to the world of the country's inability to repay its debts, due in part to the government's irresponsible approach to the debt ceiling. Global central banks, corporations, and individuals are among the creditors of this debt, with Japan and China being the U.S.'s largest debtor countries. In fact, Warren Buffett issued a clear warning about the U.S.'s current debt in his annual open letter to shareholders on February 25th. Over the past decade, the U.S. Treasury has received approximately $32 trillion in taxes, but has spent a staggering $44 trillion. These skyrocketing fiscal debt deficits, coupled with expectations of default, could have dire consequences for the U.S. In fact, on February 23rd, the Bipartisan Policy Center, BPC, predicted that the U.S. could face a debt default as early as June if Congress fails to act and lift the debt limit. U.S. Treasury Secretary Janet Yellen has informed Congress that her agency is taking extraordinary measures to avoid default and buy time for Congress to raise the $32 trillion borrowing authority as soon as possible. Speaking at a conference in India on February 25th, Yellen stated that she was willing to negotiate with the other side on significant deficit reduction. However, the risks for the U.S. may be even greater than Yellen anticipates. The release of a series of economic data contributing to inflationary trends has created uncertainty about the U.S. inflation outlook, prompting the Federal Reserve to consider another aggressive increase in interest rates. However, this move could have negative consequences on U.S. economic growth and accelerate the depletion of funds in the U.S. Treasury to pay interest on its debt. Furthermore, the Fed's decision to short U.S. debt as part of its effort to re-establish credibility as an anti-inflationary force may be contributing to the looming default on U.S. debt, revealing the vulnerabilities of the U.S. economy and the dollar. On February 25th, the U.S. Bureau of Economic Analysis released a report confirming the expectation of a recession in the U.S. economy due to continued interest rate hikes and debt default woes. The report revealed that U.S. tax receipts had plummeted to $256 billion in January, the largest drop in U.S. history, and more than the plunge seen in January 2009 when the U.S. financial crisis occurred. According to U.S. financial website Zero Hedge, the seemingly strong economic data in the U.S. is an illusion maintained by high levels of debt. For instance, although retail sales in the U.S. surged in January, creating the impression that the economy was thriving, this growth was fueled by more credit card debt for Americans. The U.S.'s current economic growth model is unsustainable, and the country is gradually sinking into debt. On February 26th, the New York Fed released data indicating that the total debt of social staples born between 1984 and 1995 had surpassed $3.8 trillion in the fourth quarter of 2022, marking a 27% increase from 2019 and the fastest rate of debt accumulation since the U.S. subprime crisis in 2008. The Congressional Budget Office has cautioned that this time around, the U.S. owes even more, interest rates are higher, and there are deeper divisions within Congress. With U.S. tax revenues on the decline, the risk of a historic debt default looms large, threatening the financial credibility of the U.S. and its creditors. A February 27th report by Goldman Sachs warned that this looming risk of a default is prompting overseas holders of U.S. debt to reduce their positions and minimize their debt exposure. To combat inflation, the Federal Reserve may need to raise interest rates to 6.5%, causing 10-year U.S. bond yields to potentially skyrocket to 5% this year. As a result, major central banks holding U.S. debt are expected to initiate a wave of reductions. In fact, some global central banks have already begun reducing or moving away from U.S. treasuries. The latest report from the Treasury Department has shown a worrying trend of global central banks selling U.S. debt for over a year now, In fact, total holdings have decreased by 5.5%, reaching $7.7 trillion as of December 2021. China's holdings of U.S. debt have seen a significant decline of about 17% in 2022, with a cumulative net sale of $173 billion. This has decreased its position to $867 billion, which marks the 9th consecutive month below $1 trillion, and is the lowest it has been since May 2010. Throughout 2022, the trend of global central banks reducing their holdings of U.S. debt continues, with Japan being the strongest seller, having sold a net of $224 billion. The situation is becoming increasingly concerning, with some experts suggesting that the U.S. is facing its worst debt crisis in 50 years. High inflation is also exacerbating the issue, adding to the cost of issuing debt and resulting in an implicit default. Given these challenges, it is possible that Japan and China will continue to sell off up to $800 billion of U.S. debt. Japan is anticipated to slash its U.S. debt holdings to only 20% of the current total, while China is expected to decrease its position to 10%. On February 27th, lawmakers cautioned Congress of the severe repercussions that the U.S. may face if it fails to pay its bills. It is clearly stated in U.S. law that the holders of U.S. bonds must be paid, making it imperative to take immediate action to avoid default. It's crucial for the U.S. to fulfill its duty to pay its debts and interest, including U.S. debt. As China keeps decreasing its U.S. Treasury's holdings, U.S. Treasury Secretary Janet Yellen announced on February 23rd that the U.S. will resume economic talks with China at the appropriate time. Meanwhile, on February 24th, G20 finance ministers and central bank governors held a meeting in Bangalore, India. At a press conference before the G20 finance meeting, U.S. Treasury Secretary Janet Yellen emphasized the importance of resuming economic dialogue with China, stating that it is critical for both domestic and global macroeconomic and financial stability. Yellen acknowledged that there is no specific timetable for the resumption of dialogue, but stressed the need for effective communication between the two countries to address global challenges such as food security, debt, and climate change. Yellen's remarks come as China continues to sell off its large holdings of U.S. treasuries and underscore the need for the U.S. and China to work together in many areas. Will they be able to come to a mutual understanding and work together to address global challenges? Share your thoughts in the comments below. This is Alex from Asianomics, signing off.